You ever get that feeling just overwhelmed by economic news? Like one minute it's inflation warnings, the next it's recession whispers. It's a lot.
Totally. It's like trying to navigate a storm without a compass sometimes.
Well, that's why this week we're doing a deep dive into the Macro Butler's latest newsletter. It's called Stars, Stripes, and Soaring Debt, and we're hoping you can, cut through some of that noise.
Yeah, and what I like about the Macro Butler is the style. It's sharp, it's witty, but it tackles really serious economic stuff, not your standard dry analysis.
Exactly. It's like getting intel with a side of dark humor. So our mission today is basically to unpack the key takeaways from this newsletter, U.S. economy, the huge debt situation, what it could actually mean for you, the listener.
And hopefully without getting lost in all the jargon.
Right. They cover a ton: trade wars, debt ceilings, inflation, investment ideas. We're going to pull out the most crucial bits.
Okay, so first up, they jump right into the trade war with China, or the supposed end of it.
Yeah, they paint this funny picture of it. Diplomats relaxing by a lake, eating super expensive fondue, like that fixes everything.
It's a great image. And they contrast that with the treasurer-in-chief's victory lap.
But the Macro Butler brings it back down to earth pretty quickly. They mention, kind of humorously but also seriously, how shipping problems could still mess with everything from Walmart stock to, like, July 4th fireworks.
And I love their analogy for tariffs.
Oh, yeah.
Taxes wearing a fake mustache. It really makes you stop and think, who's actually paying for these things in the end?
It's often us, the consumers, right?
Well, that's the implication. And that leads to their point about price controls. If businesses pass on tariff costs.
Then governments might step in.
Exactly. But the newsletter flags that as potentially risky. Empty shelves, black markets. They even make a quick wry comparison to Venezuela.
Which definitely gets your attention. It shows how these things can have unintended consequences.
And for you listening, these aren't just abstract economic debates. Tariffs, potential price controls, that stuff can hit your wallet directly.
Okay, shifting gears a bit. The newsletter also covers the disruptor-in-chief's trip to the Middle East.
Right, the secondhand jet story. But the really eye-popping part was the supposed $1.2 trillion investment promise from Qatar.
Which sounds huge.
It is huge, especially when you consider Qatar's entire GDP is only, around $213 billion?
So that number seems ambitious.
That's putting it mildly. The newsletter jokes about magic oil and the Hogwarts School of Fiscal Wizardry. It really highlights how improbable that figure sounds.
Okay, let's unpack this one big beautiful bill from
Yeah.
the House GOP that the newsletter covers. It seems like a real mix of things.
It really is. It bundles tax cuts, immigration stuff, other domestic items. It's quite the legislative buffet, as you said earlier.
And some pretty specific, almost quirky details in there, too.
Definitely. They highlight things like that 5% remittance tax that requires a verified American credit. Sounds complicated.
Mm-hmm. And rolling back green tax credits, mentioning solar panels and hydrogen dreams.
Yeah, there's definitely a specific perspective there. And then the tax deduction for tips, but only if you have the right paperwork and work in certain industries. It's very detailed.
We also see some familiar things returning, like Trump-era tax rules, higher estate exemptions, the modified SALT cap.
And getting rid of other deductions, like for casualty losses or moving expenses, it's a real shuffle.
And buried in there, or maybe not so buried, is a massive $4 trillion hike to the debt ceiling.
Can't miss that. Plus, these tax-free MAGA accounts for kids and tougher rules on IRS leaks. It gives you a snapshot of priorities.
Speaking of that debt ceiling, it's kind of weird that the official U.S. debt hasn't actually gone up since January, right?
Right.
Not because spending stopped.
But because we hit the limit. Yeah, it's a bit of a head-scratcher, especially with all the talk about cutting spending.
So this leads into what the newsletter says about the Treasury trying to maybe rebrand treasuries, move away from just calling them risk-free.
It seems like a subtle shift, perhaps acknowledging some nervousness out there. And then there's that regulatory tweak.
The SLR exemption, exempting treasuries from certain bank liquidity rules.
Exactly. The supplementary leverage ratio. The idea is to make treasuries more attractive for banks to hold, removing them from that specific capital requirement calculation.
So banks need less cushion against their treasury holdings.
Essentially, yes. But the market's reaction wasn't exactly a vote of confidence, was it? The newsletter points out that long-term yields actually rose after this Liberation Day announcement.
Not what you'd expect if the market felt suddenly more secure about treasuries. So for listeners, rising yields generally mean higher borrowing costs down the line.
Right. Mortgages, business loans, all potentially affected. And the newsletter adds that for this SLR change to really make a difference, Banks would need to massively increase their treasury holdings.
Back to 1972 levels, they said.
Yeah, it puts the scale of the challenge into perspective.
And looming over all this is the sheer amount of debt coming due soon.
It's a huge number, $7.9 trillion maturing before the end of the year. And a big chunk of that, $3.36 trillion, needs refinancing just in June and July.
Wow, so if that refinancing process gets messy.
It could definitely cause some market ripples. Big ones, potentially.
Okay, but then there was that surprise in April, right? A budget surplus.
Yeah, a rare sighting. The Treasury needed less funding than expected. The newsletter had some fun with that, the DOGE is working joke, comparing it to finding a sober sailor.
So what drove that unexpected surplus?
Mostly a big jump in tax receipts, capital gains seem to be a factor, and also a really significant increase in tariffs collected.
Ah, the art of the tariff again.
Exactly. Customs duties apparently doubled in April to a record $15.6 billion. That helped balance the books for the month.
But the newsletter cautions against celebrating too much.
Definitely. While April was a blip of good news, the bigger picture is still, well, concerning. Annual interest payments on the debt are getting close to what's spent on Social Security.
That's a sobering comparison.
And all 5 major spending categories are apparently growing faster than government revenue. So the underlying trend isn't great.
Which brings us to the big question the newsletter poses. How do governments actually deal with this level of debt? They suggest maybe not by paying it back directly.
Right. The argument they explore is that the preferred route is often inflation, letting the value of the money erode over time, which makes the debt worth less in real terms.
And they mention regulations, digital surveillance, maybe even CBDCs playing a role in managing that.
Potentially, yeah. Tools to sort of channel funds and maintain control in an inflationary environment. Historically, the newsletter notes the escapes from these debt traps are usually default, or inflation often coupled with conflict.
And the implication is the U.S. might be heading down that inflation path.
That seems to be the underlying suggestion being analyzed.
We're also seeing some shifts globally, aren't we? Central banks cooling on the U.S. dollar.
Yeah, reserve managers seem less keen, and that trend apparently picked up speed after the Russia-Ukraine conflict. Ideas floated like a Mar-a-Lago Accord, or 100-year bonds haven't exactly calmed nerves.
And U.S. bonds haven't performed as well as other G7 countries recently.
That underperformance is noted. And it's not just government debt, right? The newsletter touches on corporate debt, too.
Record amounts needing to be rolled over, potentially at much higher interest rates.
Ouch.
Yeah, that could cause some pain. And then there's consumer debt, national mortgage debt crossing $20 trillion.
With the average household owing over $100,000 on their mortgage, and rates climbing, it's pressure from multiple angles.
And the market seems to be sensing some of this stress.
Like those CDS spreads, the cost to insure against U.S. default.
Exactly. Short-term U.S. sovereign CDS spreads have widened compared to China, even Greece, since that Liberation Day for treasuries. Wider spreads usually mean the market perceives more risk.
Plus, Moody's finally downgraded the U.S. credit rating, joining S&P and Fitch.
Right, citing the big debt load and rising interest costs as key reasons. And China continues to sell U.S. treasuries.
They do, although the newsletter notes that overall foreign demand has actually been strong lately. The UK even briefly overtook China as the #2 foreign holder. It's a complex picture.
So, faced with this environment, the newsletter calls it Maleficent Gold in Lots, which is quite a phrase. What's the investment advice?
The big theme seems to be shifting focus from return on capital to return of capital. Preservation first.
Makes sense. And how do they suggest doing that?
Physical gold and silver get a strong recommendation. They see them as anti-fragile, able to withstand shocks, and crucially, having no counterparty risk.
Meaning you're not relying on someone else to fulfill a promise.
Precisely. They also suggest holding other commodities and managing cash. Actively think short-term, high-quality U.S. dollar bonds and T-bills.
What about stocks?
Favor companies with low debt, strong earnings, and free cash flow growth, and companies that actually pay their fair share of tax. They specifically mention energy and commodity producers as potentially well-positioned.
Okay, let's try to sum up the key takeaways from this whole fiscal BBQ, as the newsletter might call it.
Okay, so we have the trade war truce maybe being more illusion than reality.
That big omnibus bill mixing policy goals with a huge debt ceiling increase.
The Treasury subtly trying to manage perceptions around Treasury risk alongside regulatory tweaks.
That surprising April budget surplus, which was nice but didn't change the bigger debt picture.
Widespread debt concerns government, corporate, consumer.
Moody's downgrade, China's selling, yet still overall foreign demand for treasuries.
The potential path of managing debt through inflation and maybe more controls?
And the investment focus shifting to capital preservation, with a strong emphasis on physical gold and silver.
That covers the main points, I think. Prioritizing return of capital over return on capital seems to be the central investment message.
So what's the market outlook according to the Macro Butler? Where are we heading?
They see the U.S. in an inflationary boom right now, but heading towards a bust eventually. And they really emphasize using market data, not just listening to Wall Street pundits.
Any specific indicators they highlight?
Yeah, they point to the S&P 500 to gold ratio falling below its 7-year moving average as a potential warning sign. Also, the gold to bond ratio breaking above its 7-year moving average.
Interesting. So using these ratios as signals.
Right. And the S&P 500 oil ratio as well as an indicator of the business cycle. They see these ratios as canaries in the economic coal mine, potentially showing stress before it's obvious elsewhere. They also mention a link between collapsing public confidence and inflation.
And they suggest a strategy.
A kiss me strategy. Keep it simple, stupid, minimize entrapments. Especially important, they argue, when trust in institutions is maybe waning.
Okay, simple sounds good. What does that look like practically?
Well, historically, they note that stocks tend to outperform bonds when debt is really high.
Because owning a piece of something tangible, like equity,
Is often better than holding a promise to repay, like a bond, when the value of that promise might be eroded by inflation or default risk. Owning property over promises, essentially.
gotcha. Anything else on specific sectors?
They point out that historically, during these kinds of debt binges, the S&P 500, excluding the financial sector, tends to outperform the overall index. So financials might underperform.
That's an interesting historical perspective. And it all comes back to gold in the end, doesn't it?
It really does seem to be a cornerstone of their thinking in this environment, physical gold specifically, as that hedge against inflation, volatility, and centralized control.
Because it's outside the digital system and has no counterparty risk.
Exactly. Their final line really sticks. Gold matters yesterday, today, and especially tomorrow.
Wow. Okay, so wrapping up this deep dive into stars, stripes, and soaring debt, it feels like the main message is, well, things are complicated. The headlines might tell one story.
But digging into the numbers and the analysis, like the Macro Butler does, reveals a much more, let's say, challenging picture for the U.S. fiscal situation.
Key themes seem to be that mountain of debt, the real possibility of persistent inflation, and how that changes the game for investors.
Definitely. The landscape seems to be shifting, and the old strategies might not work as well going forward.
So maybe the final thought for you, the listener, building on all this is, how sustainable are these current trends? And more importantly, how might these big shifts in debt, inflation, and policy personally impact your financial future and the way you think about your own investments?
Yeah, understanding these deeper dynamics feels pretty crucial for navigating whatever comes next. It's certainly a lot to think